Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Well, good afternoon. Welcome to the COB. I'm Nadine Blaney.
And I'm Andrew Gagan. Yeah, great to have you along with us as we begin. Well, that's our first day of the year, isn't it?
Well, it is. And, you know, sometimes the brain moves a little slower first day back from a good solid 2 weeks off. Look, we hope everybody had a really good holiday break. I hope you didn't miss us too much. We're back. We'll get you across what happened on the 8th. I can't believe it already, of January,
so much has happened
2024.
In that time too. Since the last 2 weeks where we've been off. And of course, you know, we ended the year with a flurry.
Yep.
Bit of a different story since the beginning of the new year, though.
Yeah, it certainly has been. So it's all about rate cut expectations. It's all about inflation once again to start 2024. And the thing about this week is we get some really key data. First, just before we see the final match out for the S&P ASX 200, let's see how the COB Australia index has closed. And, you know, we were in positive territory for much of the morning, but we ended slightly negative, it looks like. And yeah, as we've got the match out going through the S&P ASX 200, we're down by about 0.5%. But Andrew, to my earlier point, I mean, we're really watching out for inflation data, not just the monthly data from us here locally, but you know, we get stuff from Japan, we get data coming from China and United States.
Yeah, certainly, as you say, inflation data on the calendar. That came off the back of the non-farm payrolls on Friday, which is actually part of the reason why we saw those markets come off again. Mind you, the ISM was more negative, so I guess there was a bit of a balance there. But we did see those bond yields rise as a result and equities come off. So that seems to have flowed through in our direction at the same time. But yeah, we'll be looking at that inflation data because, of course, the RBA meeting in, just under a month's time?
Yeah. Don't forget this year we do have that staggered sort of different schedule. It's not every first Tuesday of the month this year, but we do get the meeting in February. Between now and then we get the monthly read, which should give us a little bit of indication of what's to come in the quarterly read later this month. But globally speaking, we are seeing inflationary pressures coming off, but I put something on social media today on X or Twitter, whatever we call it, after I found a chart on Reuters just highlighting the fact that don't think about, you know, the impact of the Israel-Gaza war, Hamas war, I should say, as being, you know, an inflationary driver of the oil price. That's not it. Look at what's happening in the Red Sea. Look at what's happening for freight rates. And we haven't seen a disruption like this since, guess what? COVID, which is when we saw these real inflationary pressures due to supply chains taking hold. So there are some out there saying, beware of getting too comfy with this narrative that inflation around the globe, particularly in the United States, is just going to continue to wane. Well,
once again, goes to the story that's supply-driven rather consumer-driven. Well, let's take a look at what's making news today. Look, lithium very much in play today. Kali Metals, Whispir, Boss Energy, Paladin. Look, in terms of lithium, Kali Metals debuted today.
It did. Around 75% higher. You know, that's what's supposed to be in that first line. I don't think that the data is quite yet. I mean, it did just debut at midday. But yeah, really sort of hitting the mark.
That price, I think, is accurate, isn't it? Because it jumped around 75%, in fact, from where it started at 25. And look, I was just going to talk about also core coming off again in the lithium space, being sold down heavily given that it suspended its mining operations. Metcash there, former Premier Investments Chief Executive Richard Murray.
I still remember him from JB Hi-Fi. I think that's sort of his
and that goes to
mantle.
His track record, doesn't it? Yeah. Which is obviously impressed. And there, as a result, he's been picked up there as Total Tools Holding business following the exit of Paul Dumble.
Yep, so we've got shares up by close to 2%. Whispir, though, in the smaller end of the market. It's had this takeover tussle going on. So it's now backing a buyout bid from Soprano over a rival bid from a VC. So we'll watch that one continue to keep going. But I think it also touches upon one of those themes from 2023, you know, that a lot of these really beaten down growth stocks or former growth stocks, you know, are finding themselves really in the crosshairs of companies that are seeing, you know, there's some good prices out there. And just reminds me of a conversation I had with Jesse Moores from Spadium Capital today. It's online. You'll want to take a listen. He is really looking for, you know, massive inflows, a lot of renewed interest this year into Aussie small caps.
Now, another focus today, uranium stocks. That rounds out our top 5 there. Boss and Paladin both doing really well. Boss up some 9% as we see that uranium price continue to rise, in fact.
Yeah, and we had Britain announcing, I guess, furthering its nuclear energy program. So that helped the uranium stocks get a bit of a look in. And on that, I spoke with Jonathan Takinda from MPC Markets today. It's up there on the trade. I think it's up on the website now as a standalone interview because I thought it was really interesting. He picks a couple of names. Actually, a name and an ETF that you can look to leverage the uranium story.
Mike Gardner, also on uranium as well, who's a regular.
Also from
on our
MPC
show.
Markets.
yeah, indeed. Funny that.
Funny that. All right, Kyle Rada is joining us from Capital.com. Kyle, Happy New Year. Nice to see you. What took the wind, relatively speaking, what took the wind out of the sails here locally today, do you think?
Well, obviously it was a bit of a mixed lead, as you noted before. We did see a bit of a leg lower when Chinese markets came online. We've got the Hang Seng off by about 1.5%, at least when I last checked. And Chinese indices, the one that we price is what we call the China A50, so it's the A stocks, down by about 1% as well. So, a lot of that would be to do with the story on Friday night in the United States. This kind of change in expectations around the pace and timing of rate cuts there after the strong data. But it also, raises those questions around, possibly trade tensions as well. There's pockets of the market over there that appear to be reacting to this decision from central authorities in China to more or less blacklist certain manufacturers tied to the US defense industry. And then there's always that kind of prevailing question about, how deep is the rot when it comes to Chinese markets, the issues in its economy. And, we've got some pretty key price data out of China as well this week, which will sort of tell us about the kind of deflationary malaise that the country finds itself in. So, yeah, really, we're effectively just chopping in a range and mildly in positive territory for parts right until Asian markets came online. But now it seems sentiment is well and truly turned. And, of course, too, we've got futures in the red as well. So looking like it's going to be sort of another dour start to the week after what was, of course, a dour week last week.
Yeah, so what do you think we've seen since the beginning of the new year then, Kyle? Is it because markets, of course, running really hard into the end of last year? So are we seeing a sort of profit taking, a bit of a correction underway at the moment, or is there something more at play, particularly, I guess, with the prospect perhaps that those rate cuts aren't going to materialise as soon as perhaps expected?
Yeah, no, I think effectively what we're seeing and what's underpinned all of this is a reevaluation on the timing and pace of rate cuts in the United States. Now, I think a part of it anyway was sort of technical, if I may say so crudely, in nature, where, like any market, we sort of saw a bit of momentum taking over when it came to sort of pricing in these rate cuts, after sort of 6.5 baked into the curve at its peak, which was just before the end of the calendar year, 27th or 28th of last month. Since then, we've seen the March Fed Fund Futures contract go from implying an 85% chance of a cut to now down to closer to 60. And we've seen, again, the markets go from pricing in, say, 6.5 cuts for 2024 down to about 5.5 now. And that's been compounded by the fact that we did see that, strong US data last week, not just from the NFPs, but, also in terms of job openings, which still shows, in an absolute sense, a tight labour market. And, the jobless claims numbers were lower as well. There was obviously that concerning development, I think you could say just concerning development in the ISM survey, services survey, where we saw basically a capitulation in the employment sub-index, which does I suppose contradict everything else that we got in sort of slightly more backward-looking data. But again, this whole story really is about the changing expectations around the pace and timing of rate cuts in the United States, maybe sobering up just a little bit too. And in effect, we've seen everything else as tied to that kind of Powell pivot trade retrace, and that's effectively the story. So, effectively now we look towards these CPI figures as being the next big catalyst, because that'll tell us, effectively whether we really have to reevaluate the situation, or whether the that kind of Powell pivot trade can be sort of reignited, if you will.
Okay, so not only, and just on that, I had a really interesting interview with Catherine Young from Fidelity International today about China. So just if you want to take a sidestep and listen to that interview, it's up online, ausbiz.com.au. But Kyle, looking ahead, we also have bank earnings season. Actually, all of quarterly earnings season coming through for the US, but it starts with the banks on Friday. What are your expectations? Because obviously high hopes around the inflation read, but also high hopes around what's to come through from this quarterly report.
Yeah, definitely. And I mean, for me, this is kind of like the big contradiction in the markets at the moment when you do look at sort of price action and expectations is that, I mean, we have seen downward revisions, especially since last earnings season, for what we're going to get this quarter from S&P 500 companies. The last FactSet figures I saw were about 1.3% earnings growth. But if you look at sort of the second and third quarters of this year, the United States, of course, quarter 2 and 3, is that there's being implied by equity analysts some fairly robust earnings growth, and then earnings growth for calendar year 2024 of about 11%, which would be fairly consistent with an expanding economy and one which, certainly wouldn't typically be seeing inflation going in a sort of a disinflationary trend. So we've got rates markets more or less discounting these 5 or 6 rate cuts at the same time that you've got equity prices apparently reflecting what is incredibly robust earnings growth. So it sets up the markets actually, I think, for a level of disappointment, because although we can maybe see some upside surprises because the bar is set low for this particular quarter, a little bit like last quarter as well, we're really prone to some downgrades coming through here, especially if tech fails to deliver, because I think there's a lot discounted there in terms of big tech, the Magnificent Seven delivering on effectively, finally delivering on some of this kind of AI hype, and then also the consumer sectors too, which have proven resilient. And there's this sort of vague expectation that maybe that resilience will continue, but into a slowing economic environment, that's highly questionable. So that's kind of what we're looking at. I think it actually poses some more downside risk because of the elevated earnings expectations for this quarter. And yeah, the banks will kick things off as kind of the proverbial canary in the coal mine on Friday.
Kyle, great to kick things off with you this first trading day of the week. Thanks for joining us on Capital.com.
See you soon. Thanks, guys.
So let's just quickly run through some of the best and worst performers to see if any of those corporates, the slim corporates with news out there made the list. And look, it's just a sentiment thing when it comes to uranium, because none of, Boss Energy, Paladin Energy, these companies didn't have news out, nor, Andrew, did De Grey's, did Regis, or as far as I can see, did GUD Holdings.
Yeah, well, certainly, and we've spoken about uranium and the prices there. Also, well, obviously a couple of gold miners there. It was a bit of a mixed picture, actually. In fact, the gold miners more generally there. But we did see the gold price hold up. It's sitting above 2,000 with expectations. In fact, a number of brokers I spoke to and fund managers expecting that gold's continue to go to run.
All right. We'll see. It's always at the beginning of a year. It really means something when you say, we'll see. Okay. Core Lithium, as you've said, it paused its development in the Northern Territory, its new production there, down by a further 17%. Magellan did get a broker downgrade today. It's off by 8%. And yeah, going through the list, I don't see any news around for any of these companies, but that's what it's like sometimes. It's still pretty quiet out there. It's still very quiet in the city.
If you're in that mode, aren't you, when you want to hit the sell button, then, you just take a look at some of those stocks, so particularly, I guess, in some of those cyclical spaces at the moment too, where it's pretty easy to sell them down. Yeah,
I dare say we won't have a lot to add when it comes to these small to medium-sized companies here, but let's have a look. Something happened with MedAdvisor, up by with more than 30%. I'll look into that one. Also, Experience Co. It runs a lot of tourism operations around the place. I just did an interview with LIS Energies. They've got that Geelong plant pretty close to production. He did say that on time, on budget, looks like they will be into production at least by March. So that's a good one there.
Just with MedAdvisor, I think I did see something in the Fin today of a fundie who was among his picks in the small space, in the micro caps, and saying that is a stock to get onto.
And with a 30-cent company, something like that can move the dial. Flipping the page, though, to see the flip side. Okay, there you go. Appen is one of those companies down by 15%. Pretty rough ride for Appen shareholders yet again this year.
All right, so let's get to our stock of the day, Biome Australia. In fact, you just spoke to them a little earlier, but we caught up with Daniel Artesi from the Stock Doctor and also Scott Phillips from the Motley Fool for their rating on the stock.
If you are in that space and you can either have some significant evidence or just a general acceptance or belief in this, then it's a good place to be. It's also great to be small. It's on one hand really, really hard to get growth. When you're a tiny business, no one knows, really hard to get going. But at some point, a little bit of growth on a very small base adds up and adds up and adds up. Now, they're talking about having $12 million in sales over a year. For a small business, that's great. But of course, it pales into insignificance compared to almost any other meaningfully large company on the ASX. So getting an extra $1 million in sales shouldn't be that hard if you have a product, if you have a market fit, if you have a consumer base. So I kind of like the idea of Biome. I wouldn't necessarily invest in it. It's still losing money. We don't yet know where the ceiling is in terms of profitability and sales. Every company finds eventually a maturity phase. If they get that far, Biome not even making money, as I said. So still a while to go. But one to watch, and that sequential growth, all you can ask if you're a small growing business is, hey, are you doing what you said you were going to do? Are you growing? Are you getting traction? The answers all seem to be yes on this one. So again, not worth my money just yet, a little bit too early, but very hard to say the company itself isn't doing a really, really good job of growing, doing what it can to be more successful. They're certainly ticking those boxes.
Yeah, they're hitting that inflection point at the moment, but I think they had about $3 million in cash at FY23 and a little bit of debt on the balance sheet. So I think raise is to come very likely at the moment. So for that reason alone, I'd probably prefer to be out of it. Perhaps once the raise and the presentations come out, see what the strategy is.
Well, Andrew, after just speaking with the CEO, I've got to say he took a little bit of an issue with those expert views. He said, well, that's interesting. He's talking about a raise when nobody in the business is, basically saying, yeah, they got it a bit wrong. Look, you will have to do your own research, information, not advice. But I will say the share price of Biome over the past year, I think, is up by about 190% or something like that.
Yeah,
so
that's
we'll
been
see.
impressive. But to your point, worthwhile going to the website, checking out the interview you did with the company, and then also taking a listen to both what Scott and Daniel had to say about the stock.
And maybe getting advice to say it again.
Absolutely. All right. Let's take a look ahead. Now, US consumer inflation, we were talking about that. Huge expectations there, what it will deliver. Look, on top of that also, a bit of Fed speak as well.
Yeah, tonight we get Bostic. I wonder, I don't actually know who else is scheduled for this week. We get a read on consumer credit and also inflation expectations. And in the Eurozone, which, will be getting up and running relatively soon, we get consumer confidence and we get a Centix investor confidence read as well.
And tomorrow, we'll take a look at retail sales. That's going to be interesting off the back of Christmas, of course. Building approvals for November. And elsewhere, Eurozone unemployment data and German industrial production as well. Locally, Premier Investments goes ex-div.
Yeah, it's one of those companies that reports out of cycle, so that's why we're getting that one at this late stage. Speaking of late stage, I think we're getting the big wrap up here, Andrew, and we've got the last of the day's trades having gone through the S&P ASX 200, really reflecting what we saw in the COB Australia index today, down by about 0.5%, so that's not the best way to start the week, but we've got 4 more days.
Yeah, well, for the rest of the year, Nadine.
We've got the rest of the year, Andrew, to look forward to. So on that note, I guess we'll be here to do it all again tomorrow.
Absolutely. See you then.